Welcome back, everyone. Michael here with Offshore Citizen. Today we're going to answer the question that comes up a fair bit, which is, can you remain living in your home country while setting up and benefiting from an offshore structure? It's a question I hear a lot, so we're going to cover the details as it might apply to you. Before we get started, click the subscribe button, the notification little bell, and let's get into it. Okay, so what's the deal here? The deal here is a lot of people seem to have the idea that you need to move abroad in order to benefit from international structures, okay? And they seem to think that, hey, listen, so long as you're in this country, you follow that country's rules. And so, there's no options for you. Now, this comes from fundamental misunderstandings about how international structuring rules work, okay? So if you want to go and check out some of the videos I've done on source income, on residency, in particular corporate residency, on CFC rules, etc., you can check those out and you can get a little bit of a sense on how it goes. Now, it is definitely true that there are consequences that might be different if you remain in your home country versus if you go to another country, provided that country has somehow more favorable rules, okay, which is not necessarily the case. Let's get into the way that this goes. So it depends, first of all, on what is your objective when you're setting up an international structure, okay? There's lots of different reasons you might do this. For instance, to optimize your taxes, to somehow protect your assets, to enable you to access some sort of infrastructure, something that you might not normally have. So for instance, someone who is in the US, who maybe has a CBD company, maybe can't get payment processing there, and sets up a structure in Ireland or UK in order to benefit from EEA processing, okay? So that would be a different use case. Sometimes maybe you're in a country where you want to access better banking, better access to currencies, etc., right? There's lots of different reasons why you may set up an international structure. And when you set up an international structure, you need to kind of keep that in mind, because some of those different directions that you may go may influence how it affects whether you're local or not, okay? Fair enough. Now, from there, we have to ask the question of, all right, if you're going to set that up, are you going to be impeded by some set of local rules? And certainly it is true that in certain cases, and the one that really comes up that I'm going to focus on here is taxes, that those rules may, you may not get the full benefit from them. So let's use an extreme example. You move to Bahamas, you're living in Bahamas, you have zero tax, that's it, right? On the flip side, maybe you're in a situation where you're in a country, okay, great, you have a business that you can't make it international, okay? So no matter what, even if you were to set up a foreign company, you're going to pay foreign domestic taxes on that company, and you're going to pay domestic taxes personally, okay? Those are kind of like opposite extremes. Most people who I work with, and generally the situation that I've seen, is a lot of people, when we're setting up structures for them, they don't want to move abroad. We're not designing it based on the idea that they're going to move abroad. What we're designing it based on is the idea that they can take advantage of, the structure of the rules locally insofar as they can in order to reduce and optimize their situation. And it's probably not going to be as great as if they were to move, but it still could be a significant benefit, okay? What are some examples of this? Well, let's say that you're living in Canada, okay? And you're able to set up a foreign company because your business somehow has some portion of it that is international, or you can internationalize it, right? So you can get all or a large portion of the company's income can be international and can be zero tax potentially, okay, if you structure it properly. Then you can repatriate those funds to a Canadian holding company tax-free, okay? So what did you just do in that situation? Now, will you eliminate the personal tax in this? No, you will not. The personal tax you're going to pay, usually when we're talking to people, usually what we're dealing with is somebody who is in a country that's high tax. They're probably still going to pay personal tax, but they can avoid or reduce the corporate tax, and that may be to a sufficient degree in order to make it worthwhile. And we're going to get in a second into how much does it take for it to be worthwhile, okay? So let's say that you pull out, I don't know, you're paying $100,000 a year in corporate tax, right? And maybe you can reduce that by $50,000. Well, you save $50,000, right? So you're ahead of the game there if you're in that situation. There's different ways that you might be able to do this. The one is a foreign company may pay a lower tax rate. You may be able to optimize your write-offs better, and you may be able to defer. And the value of deferral alone, in some cases, is enough to justify the structure if there's enough money and the growth is able to be sustained long enough over a long enough period of time. Okay, so if you're in a situation, it could easily pay for it, but it depends on your scale. And so this is a bigger question. The question is not, can you set up an international structure, an offshore structure, and benefit from it while living in your home country? The answer theoretically is yes, but it depends on your circumstances, and it depends on whether it's worthwhile for you, whether it's optimal. Because, okay, you can set up that structure, but does it pay for itself and give you a high degree of profitability? That's a different question. And so usually what I tell people is, look, if you're not making a lot of money, then generally speaking, don't worry about international structure. Just go out and work on making more money. That's the best advice in that situation. But if you're paying, I would say when you start paying $50,000 to $100,000 a year in tax, it starts to make sense to look at it. When you're paying $50,000 or $500,000 or $1 million or $2 million in tax, it almost certainly is there's an opportunity somewhere there for you to optimize. Okay, so that's the biggest thing. The biggest thing is it's going to cost you some money. There's going to be some effort. There's going to be some time. There's going to be some hassle involved in setting up a new structure and maintaining a new structure. You're going to have to follow some complex rules. That may require some differences in reporting. That may mean that your accounting costs go up a little bit, right? So let's say that it costs you $30,000 to set up a structure and, $20,000 a year to maintain it. Okay, well, if that's the case, then your tax savings better be a lot more than that. So I would say, you want to save in that situation probably at least $60,000 a year in tax. If you're saving $60,000 a year in tax, it makes sense. Can you do that legally within the bounds of the law? It depends on the nature of your business, and it depends on the country that you're in. In many cases, if you have some sort of a digital location-independent type business where you're selling online, where you have contractors who you're hiring overseas, etc., then yeah, you quite likely can if your business has enough scale. If you're operating some sort of a bricks and mortar business, then no, probably not. And again, it depends a little bit on the country because some countries allow you to repatriate tax-free, some don't. Sometimes there's restrictions where you can only repatriate from certain countries. So maybe you knock the tax rate down from 22% down to 10, and so that's the differential. You're not probably, if you have presence and activity, you're involved in the business in your local country, then there's going to be some tax payable there. The question is, how much is the divide, and can you justify it so there's a sufficient switch? That's the real question, and those are the facts that we need to dig into for you personally in order to figure out. So anyway, if you're interested in that subject and you'd like to look at your situation, please feel free to reach out to us. If you have questions in general about this topic, you can put them in the comments. But otherwise, you can book a call with me. There's a link below, clarity.fm/Michael Rosmer. You can check out our websites, offshorecitizen.net, offshorecapitalist.com. Please subscribe, like the video, and we're going to see you guys on the next video.